Well, let's take the profile of the person who is all in and who should be all in. Let's say you've got $1 million. Let's say you got that invested even recently, within the last couple years. That probably means that you have a cost basis of, I don't know, $500,000. That means maybe you have a capital gain of $500,000. So if you're going to sell, if you're going to back off, you're going to have a huge tax bill. Let's say you're a client of mine who is in this for the dividend income, and that dividend income supports their life. So you've got $1 million, you have a $500,000 capital gain bill, and you've got an income stream that you totally depend on. What would you do if you sold out? You would create a big tax bill, you would cut off your income, and for what? To try to be cute, to try to avoid another down 10% from here? We know that recessions and bear markets, they're just part of the process. So if you've got that situation, and you've got a time frame, let's say longer than 2 years, I would say longer, maybe 3, 4, 5, why would you get out now? If that's your profile, it's absolutely fine to be all in because you're in it for the long run. And this is where I think when you say you can't be all in, I think this is where you really dissect and diverge on investor versus trader. If you're a trader, if you have trading mentality, if that's your path for what you're doing and how you're investing, then yeah, you can't be all in. But if you're really long term, if you're dependent on income, if you have big capital gains and you're just in this for 10 years, 20 years, 30 years, then stay all in. Like, don't worry about this. This is noise. And actually, I was in an argument with my husband about the market being down 4.7% for the quarter. I was calling it a blip, and he was saying that's callous, right? So I think in the long-term investing, even down 5%, that's a blip. Down 10%, that's a blip. Knowing that over the long term, we march and trend upwards.
Okay, we thank you for taking us into your. We thank you for taking us into your house for the secrets.
Thank you.
Of the Harringtons, I think. Sarat, how about that? What if 10% is conservative? What if we need to go back to lower levels where it makes more sense because of what's coming from the Fed and how the earnings picture is going to be impacted by all of that? I mean, you know, Cooperman was talking about what kind of multiple, you know, he'd put on the market. Maybe it's 18 times, and he gets to like 40, 50. Seems like a reasonable level to him. Well, that's, you know, that's 400 points lower than here. That's 10%. What if we need to go down further than that, Sarat?
Yeah, I mean, look, we tested 4,200, and you know, Jenny's right in terms of being a investment manager advisor. You kind of have to look at the client risk profile. If you're 30 years old and you have a 401k, you should be all in. But if you're 70 years old and you're relying on your portfolio, and today you're 75% equities, you've had a huge run in the last 2-3 years. You should be cutting back to your risk profile. But, you know, let's get back to kind of where the market's going to go. Valuation is really going to matter in this case. And if Cooperman says 18 times, well, where are you going to be in that space? There are a lot of companies today. I mean, you look at your financials trading at 12, 13 times. They've come down from, you know, 15. Industrials have come down. So a lot of the parts of this market have reflected that. The question is, how much lower can some of these go? And as we know, when momentum goes the other way and you get cash coming out of the stock market, part of what the Fed is also doing is actually making the fixed income market attractive for people who weren't in it. So, you know, on a Jenny portfolio, some people will say, I'd rather get 4% lending, you know, to a big corporation than getting a dividend. And that's going to happen, too. So I think, you know, market's going to find its spot. But with the Fed raising rates, valuations are definitely compressing. We've seen it. And now with earnings season coming forward, I think the market's kind of sensing like, hey, what's going to happen with all these higher input costs and geopolitical issues going on?